Hey, what's going on, my friends? It's your man Adam A. Spencer here with another look at our dividend portfolio. Yes, every week we contribute $25 into this dividend portfolio. Today it's January 23rd, 2022, and things are still in the green for us despite the market. Because some people are like, we're in a crash. Some say it's the start of a crash, but all across the board, portfolios are red, including our growth portfolio. If you guys saw that yesterday, we are down quite a bit over there. And fortunately for us, we're not down in our dividend portfolio. At least not yet. It might, it's going down a bit. I don't want to brag like, oh, we killing it. We're still up. So I'm grateful. And regardless, we will be contributing $25 every week into this portfolio. So we're going to dive into this to see how things are going. But before we do, if you haven't started to invest with M1 Finance and create your own portfolio, definitely consider doing so. You can use my link down below. If you use my link, you will get some free cash when you start and fund your account. And also have a link to Webull, another one of the platforms I use for investing. And if you use my referral link for Webull, you'll get some free stocks. So not a bad way to help pick things up a bit and have some positive news with everything that's going on with the market right now. And lastly, before we jump into it, if you haven't yet, smash that like button. It does let me know you guys enjoy and appreciate this type of video content, and also subscribe to the channel so you guys can stay up to date on my latest videos to help you with making, managing, and growing your money. So as you guys can see, over the past day, we are down 0.58%. Over the past week, we're down 3.42%. Over the past month, yeah, see, people out there, they are not happy with what is going on with the stock market. I know, we're down. It sucks. It stinks. So over the past month, we're down 2.31%. In the past quarter, we're down 2.38%. However, the past year, all time, we are up 6.12%. Yes, we are still in the green. We are still up with our dividend portfolio. And of this, you can see we have earned $54.81 from dividends. And then there's about $17.69 of market gain, which this is what continues to decrease and lower as our portfolio is starting to kind of level out a bit, go down a little bit, because last week we were definitely up a bit higher than where we are today. So hopefully we can stay afloat despite what might potentially come. But if not, regardless, we will still be contributing $25 every single week into our portfolio, because when we look and see who is doing well, who's not doing so well, you can see Pepsi is at the top of the list, holding us up strong with at about a 37.27% return, followed by Procter Gamble, who's up 30.24%. And we're actually going to dive into an article that I found that just shares some good news and reasons why we have Procter & Gamble in this portfolio and why you might want to consider adding them to yours. Followed by Coca-Cola up 26.95%, Newt up 18.89%, Realty Income Corp up 13.62%, Johnson & Johnson up 5%, and then Verizon Communications, whom I feel like they've been down for quite a while, is up 0.23%. Then in the red, unfortunately, JP Morgan Chase is down 5.88%, followed by 3M down 8.04%, and then Innovative Industrial Properties down 25.83%. So, hey, as a whole, I'm amped. I'm satisfied. I'm loving it because, like I said, everyone's portfolio out there is down, and this portfolio is still holding strong. Of course, it's early. Who knows what might potentially happen in another month, another 2 months. A market crash we could certainly be in it already. And it could last a few months. It could last a few years. Fortunately for us, we will be investing in this portfolio for at least 2 to 3 years at the minimum, but potentially 5, 10 years, maybe longer. And the beauty of this portfolio is that we will be getting our dividends. And it's not just about the growth of the companies and how much the stock prices go up. We're always going to be getting our dividends as long as they're paying them out. And if they cut them, just like we cut AT&T from this portfolio, we going to cut someone else if they're going to cut that dividend. So we want to make sure we continue to get paid, but also that the company itself is continuing to do good things, continuing to move in the right direction. Now, as I mentioned, I did pull up an article that dives into Procter and Gamble, who is performing well for us. You know, some periods where it's been a little choppy, but as a whole, they are still performing fairly well, keeping us up strong. And so I thought I'd share this article that has 3 new reasons to love Procter and Gamble stock. This just came out on the 19th. And the first number 1 reason is because Procter and Gamble is beating sales targets. Investors had been looking for Procter and Gamble to post just a 3% sales uptick, which would have come on top of the prior year's 8% spike. But instead, the company reported 6% higher organic sales, with each of its 5 core divisions growing year over year. The fabric and home care segment, home to brands like Tide detergent, was a standout. The healthcare niche also received a boost from higher demand for flu symptom management that's likely tied to the latest COVID case surge. But Procter & Gamble achieved a surprisingly strong balance across the portfolio of higher prices and rising sales volumes. We delivered very strong top-line growth, CEO John Mueller said in a press release. The number 2 reason is because Procter & Gamble is dealing with cost increases. Procter & Gamble did face challenges around rising costs. In fact, gross profit margin dove by 4 full percentage points due to soaring prices for raw materials like plastics and higher freight costs. Yet, the company offset those pressures with savings in other parts of the business and by hiking prices. It also helped that consumers are still spending aggressively on premium products like Tide Pods. And so the bottom line profitability fell by 2.5 percentage points, translating into core earnings per share growth of just 1%. That result was better than expected. It also implied that Procter & Gamble finally has a grip on inflation, which is set to pressure earnings by over $2 billion during this fiscal year. Number 3 is more cash returns. The new annual outlook was packed with good news for investors. Procter & Gamble now sees sales growing by between 4 and 5% in 2022 compared to its previous target range of 2 to 4%. We'll get a better idea about how that translates into market share growth after rival Kimberly-Clark reports its earnings in late January. However, Procter & Gamble appears to be winning more than its fair share of consumer staples categories like home care, baby care, and beauty products. Executives also confirmed their outlook for earnings that calls for core profit to rise by between 3% and 6%. Yes, that equates to a modest drop in profitability this year, but investors were worried about bigger declines thanks to inflation and supply chain challenges. So the cash flow forecast received an upgrade, which means Procter & Gamble has more resources it can invest in the business, even while spending aggressively on dividends and stock buybacks. Management now expects to return between $17 billion and $18 billion to shareholders through these channels in 2022, up from the prior goal of $15 billion to $16 billion. The high end of the forecast would mark just a modest step backward from last year's $19 billion of cash returns. That success implies that Procter & Gamble is avoiding the type of growth in earnings hangover that Wall Street had feared after demand surged over the past 2 years. And here's the key part, my friends. It should also amplify total returns for investors who simply hold the stock over the long term. And that is exactly what we are doing. Dollar cost averaging is going to allow us to just run with this bad boy. And, if it tanks a little bit, that's fine. We're dollar cost averaging it. It's not like we threw all this money at it one time and then it tanked. No, we are contributing a small amount every week. And so we can ride with the companies we have in our portfolio and make sure we are getting those deals when they arise. That's how you got to look at these crashes, right? Look at it as deals. Now, of course, again, if you're going to need your money in the short term, well, you might want to consider, maybe this isn't legal or financial advice, but you might want to consider pulling out, taking the loss right now, because you don't know if it's going to continue to go down. And if you're going to need that cash in a year from now, well, that's a huge hit you just took right there, especially if it continues to fall. That said, if you don't need your money anytime soon, some of these companies like Procter and Gamble could be great investments for your portfolio, and being able to buy them now while the market's starting to crash or while it's crashing is usually a nice situation to be in. Because, my friends, it's all about your time in the market instead of timing the market. If you jump out now, you're going to be like, all right, I'm going to jump back in at the right time and I'm going to hit it right when it's at, right when things about to bounce back up. It's like impossible to predict that. Instead, dollar cost averaging is going to allow us to continue to contribute every week towards these stocks and these companies that we want to continue to invest in, which is only going to allow us to add more and more shares to the pool. And when things do bounce back, when things are in a good place, at that point, we're going to have even more shares because we continue to buy every week. So I hope this makes sense to all of you guys out there who are new to investing. And I also want to mention, if you want to open up your own dividend portfolio, consider using my link down below in the description. If you use it, my referral link, you will get some free cash when you open and fund your account that you can just throw in your portfolio and get that money to start working for you quicker. Or use my Weibo link and you can get some free stocks. Yes, free stocks. I know y'all love free stuff, so definitely get the ball rolling over there and get the ball rolling with your portfolio. Start investing in your future and getting your money to grow for you, getting your money to work for you. Because we are still up even with the current market and everyone's portfolio, our growth portfolio that you guys might have saw yesterday. But we're still up over here when you have these valued companies in here that are giving out dividends and keeping, staying strong. But like I said, it absolutely could tank more than what it has, because we were up like 13% a week ago or 2 weeks ago. Now we're only up 6%. So either way, we will be buying the dip if it dips even more. So let me know what you guys think about the portfolio. How is your portfolio going? And of course, subscribe to the channel. Smash that like button. But you guys already know I gotta keep it moving. But I'll see you in the next video. Peace.